March, the day after St. Patrick's Day, celebrating. But nonetheless, oil markets have opened in Asia, as we do track that every morning here in the Middle East. They have opened down for the 5th day in a row. Let's kick off with Chris Bake of Vitol. Chris, why have, from your perspective, prices, it would appear, hit a ceiling on $70 and are sort of hovering now below that?
I think the market's recovered incredibly well. If you think about where we were a month from now, a year ago, and the lows with the massive uncertainty, the first lockdown, market very confused as to what actual demand was going to be, and the recovery from there, backed with a huge amount of OPEC discipline, the market has improved incredibly well. So 60% since the fourth quarter of last year we're up. And I think it's temporizing here a little bit, some uncertainty on demand in Europe on the back of extended lockdowns. Asia is doing quite well. Inventories have worked off hard, but the market's anticipating further draws into the second half of the year, but is probably temporizing a little bit around here as it tries to figure out the next level.
I mean, Chris, this is still a vulnerable market, one would have to say, with 8 million barrels of idle capacity. I don't think we've ever reached these highs with that paradigm before. Is this the limit one could expect from that upsurge, given the sort of fundamentals still are, and the IEA referenced it yesterday, there's no shortage of supply around?
There's no physical shortage of supply around. The perception has been, and what's driven the market is an incredible amount of OPEC discipline. I think they've told us to expect the unexpected, and we've got it from the incremental cuts that came out of OPEC, specifically Saudi, to where the current balances sit. But the drawdown of inventory and the market structure has forced a lot of inventory to go. And the demand equation is still fairly strong for the second half of this year, with a return to, aside from the distillate pool, jet specifically, some fairly robust numbers, which we are seeing in the East, and we are seeing those recoveries in the US. So physical oil around today, there is oil around if you need it. But again, the market's pricing forward view, and it's pricing continued OPEC discipline. So it's has tried to force OPEC's hand to release more oil. They didn't, and that maybe surprised the market a little bit a few weeks ago, and now it's temporizing where it is.
Carole Nakhle, CEO, Crystol Energy. Carole, the federal chairman yesterday, Jerome Powell, sort of late to the party to an extent, but nonetheless, to hear it coming out of his mouth, U.S. forecasted growth at 6.5% for 2021, 2 full percentage points higher than the last time I think he mentioned that forecast. It's a massive growth outlook for the world's biggest economy. All boats will be rising on the back of that, one would think.
Good morning, Sean, and happy first anniversary. With respect to the revisions, the upward revision to the US economic growth, that definitely is a big increase. But mind you, almost a week or 2 weeks ago, the OECD doubled its forecast, and I think added another 3 percentage points for the US growth. So everybody's expecting big improvements, big recovery in the US economy. Of course, when you're talking about the world's largest economy, you would expect that to have positive spillovers on its major trading partners, including the Euro area, but also North American countries such as Canada. So there is definitely an uplift mood to that, partly because of the passing of the 1.9 trillion fiscal stimulus package that the Biden administration has been pushing for several months. And then that happened, and now they're talking about something else, about the infrastructure investment. You also have the rollout of vaccination, and the US is doing a pretty good job, especially compared here to miserable Europe, where things don't seem to be going in the right direction. On the contrary, we seem to be going in the opposite direction. So there is a lot of positivism coming from North America, from the US. But unfortunately, when you look at the global picture, you see a very uneven picture. And here in the Euro area, at least, things don't look as rosy as elsewhere.
Andy Critchlow, head of news, Europe, Middle East, Africa at S&P Global Platts, who was our first guest on this show a year ago. And welcome back, Andy. Thank you so much. Chris mentioned that the OPEC discipline is really the sort of 10,000 pound gorilla, if you like, that this market is built on. But yet we're seeing Iran now, 1 million barrels a day would appear in exports. So we've got Libya well above 1 million as well. There's a lot of outliers that could challenge that OPEC discipline going forward. Andy, your views?
Yeah, I think it's a very good point, and thanks for having me back on the show, Sean. You know, a really important thing happened this week, and it's kind of gone forgotten in the oil market. Libya finally got an oil minister. It's been years since Libya had an oil minister, and you know, there's a significant thing there because Libya's Africa's largest holder of oil reserves. You know, it has the potential to go up to 2 million barrels a day of production. They're about 1.2 at the moment. That crude flows into predominantly into European markets, can go into Asia. There's a kind of scramble going for markets at the moment between these producers, which is really fascinating. I saw this morning that the Indian oil minister is having bilaterals with the CEO of ADNOC. This comes at the same time as India and the Indian state refiners are kind of pushing back on Saudi for these cuts and saying, hey, look, we can't really stand crude trading close to $70 a barrel at the moment because our economies are quite fragile. The last time I remember that happening was back in like 2009, 2010, when we had prices above $100 a barrel. And India, actually, if I remember rightly, that's when I was kind of covering OPEC, more from as a correspondent. India actually wanted to go to the OPEC meetings and kind of complain and say, hey, what are you doing? So
they're doing the Zoom version of that at the moment.
They are doing the Zoom version of it at the moment. So, we're in this really interesting point in the cycle where the customers are starting to say, hey, look, we can't take this. Another really interesting fact that came out today that we reported at Platts was this increase in US crude into India. I think something like a 29% rise over the last year of US crude flowing into the Indian market. So I think that what that says to me is this battle for market share between these OPEC producers, and it talks to your point, is how can OPEC maintain its discipline when all the producers that have suffered more economically now are going to race to bring oil back to the market because they want that market share. They want to secure their customers. They want a higher price. They want to secure their economies for the future.
Chris, your views on that? I mean, we've seen in the recent days the reporting that India turning away from the Gulf, from Saudi Arabia, as some kind of a punishment reaction to the decision by OPEC Plus last time not to listen to India's pain. But is this something more long-term? The composition of the US barrel, a sweeter barrel, may be something that the Indians like regardless of the politics. What are your views on this change as something more long-term?
I think that is on the margin right now. I think an overall shift, the suite of barrels out of the Middle East are required. If anything, the US has plenty of incremental capacity to handle heavier mid-grade and heavier crudes. So will we see US light sweet heading east and Middle East heading more west than it has traditionally? Maybe on the margin, but that makes some fairly dramatic shifts in pricing and in freight expense, freight costs. So it's I see it, yes, as a reaction, but I don't see it as a structural change yet to the market. I think Andy's point about more stability in Libya, it'd be interesting to see how the new minister does. It seems to be some conflicts between him and the chairman of NOC. So on one hand, it could be a stabilizing effect. On the other hand, Libya has managed to navigate fairly troubled waters for the past 10 years. So does it escalate the level political tension in country, again, by having two authorities around the oil supply, something to watch. But I think it pivots back to the point we were making before. The market's recovered well. It's at a pricing point that many of the producers need, not even want, but need. And the consuming side is pushing back where they can to some extent.
Chris, from the market actors' point of view, traders obviously had a great year across the board. All of your peer group. We have a regular commentator out of Australia, Peter McGuire, CEO of XM. Australia always says if you couldn't make a buck as a trader in the last year trading oil, then you might as well go to the beach. The reality now, however, I'm wondering from your perspective, have we now reached the end of that freebie in a way, and that now the challenge is becoming, as we come out of the COVID forest, a little bit more difficult to assess all of the elements, which direction they're going? What are your thoughts about that sort of dynamic going forward as compared to where we've come from on the trading side?
I think the lack of the carry trade or the disappearance of the carry trade that was very much there through last year is a fair comment. I think in terms of the opportunity set in the market, it continues to be there. The battle between the products, be it the middle distillate pool, the emergence of or the lack of emergence of some of the heavier barrels because of a curtailment in some of the heavier crudes, and what that means to the market, and figuring out how to handle the incremental distillate, specifically jet in the market, are going to continue to be challenges for the refiners and those of us who are trying to balance supply demand around the world and trying to figure out how to move the incremental barrel. So there's always opportunity, but there's always this balancing act that has to continue as the demand slates change and the patterns of supply change.
Carole, another comment out of the Fed yesterday, which sort of touched on this ever-growing question of where is inflation going there and where will rates then follow. We had the Federal Reserve continue to maintain its sort of bearish, softer approach to the markets, but yet there is a growing number of voices in the Federal Reserve that are bringing forward the possible start of an interest rate hike cycle. Your thoughts on that and the commentary that you heard regarding inflation and its impact for the markets?
First, Sean, if you compare where we are today in terms of debate, not only about inflation, economic outlook, but also about the direction of oil markets and oil prices, you see that we are like the gap between different expectations, it has widened significantly compared to what we had last year. So today, for example, yes, the Fed is saying, yeah, we might see a rise in inflation this year, but we'll go back to normal next year. But the voices within the meeting yesterday, for example, that took place that are warning of inflation seem to be rising compared to only a few months ago. The same thing for expectations about oil prices. We see more, for example, traders are divided, but there is a bigger voice saying that we're heading towards $100 a barrel, the super cycle, commodity super cycle. And then yet you have other international agencies such as the IEA saying, no, this is not going to be because the market is comfortably balanced for the next few years. So we are seeing more of this dichotomy in expectations. And I think only time will tell. With respect to the Fed's announcement recently, I think let's see if the market is going to buy it, because they're trying to appease fears in the market, just like other officials also from the US are trying to say, no, these fears of inflation are overblown, but we are yet to see if the market is going to buy that. And we're going to see whether the volatility in, for example, the stock market will be maintained or not, to see if Powell managed to convince the financial community. I want to go back to one issue with respect to India and the impact of high prices on the economic growth. Of course, there is a lot of concern there. But the way also I see it is there is another layer of this kind of noise, which is mainly shifting some of the blame with respect to the pricing reforms that they applied domestically to an external actor that is OPEC, by complaining that, yes, the higher prices are not because of the reforming of subsidies, but mainly because of OPEC. So it's not just about saying it's impacting negatively the economic growth, it's also putting a softer package on the policy changes that have been pursued recently.
Andy, welcome your comments on the outlook for the geopolitical dance between the US and Iran, the rapprochement. We had the news overnight of the US in some way warning China that they were going to continue to police the illegal exports, according to US sanctions, illegal exports to China, which are now reporting by a number of secondary sources up to 1 million barrels a day. How do you see that playing out and its impact for the markets?
I mean, I wouldn't bet on it. I think that the US administration has a lot of fish to fry at home at the moment, and they tie to the economy, to just getting the Biden domestic agenda on track. I think that real heavy lifting in terms of the approach with Iran, in terms of rebuilding the nuclear agreement, if they want to go down that route, and restoring Iran to the oil market, I think it actually comes later in the cycle. I think that kind of geopolitical question, though, I think it's actually a lot closer to home. And I think actually it's what's happening in OPEC that's really interesting at the moment, and it's actually between Abu Dhabi and Saudi Arabia. And I think it's fascinating what's happening there in terms of what Abu Dhabi is doing around ADNOC. They're launching this new Murban crude contract. I've seen a lot of commentary around who are the losers in this. People say, oh, it's WTI is going to lose, Brent's going to lose, etc. The real loser, unfortunately, the real loser, if you look
is that a bark of support to the profound point you're making?
I'm going to take it as it is. The real loser in this, actually, if you look at, we built, some people wrote books in the lockdown. We built a periodic table of oil, and we kind of laid out 150 different crudes and categorized them. It's a great tool. Go and look at it. Platts.com. You can find it. If you look at Murban, what are the crudes it actually competes with? Arab Extra Light, both same volumes, 1.4 million barrels a day, virtually the same loading point, pretty much the same markets. So, what Abu Dhabi is doing, arguably with this new Murban contract, is they're trying to make their crude more attractive to buyers, ultimately increase the pool of potential buyers. Who are the losers in the region? It's Saudi Arabia. At the same time, the Saudis have this kind of spat with India at the moment over the price of crude and some of their arbitrary policies around OPEC, etc. I take Carole's point that a lot of this, is a little bit of kind of back and forth in terms of India and some of the domestic policies there. But actually, are we starting to see these two heavyweights in OPEC starting to walk in different directions? Part of OPEC Plus success, part of OPEC's success has been Abu Dhabi and Saudi Arabia, two countries actually who historically in the Gulf have never actually been that close.
So let's give Chris a chance to comment on that point. Obviously, next week the IFAD, the Abu Dhabi or ICE Futures Abu Dhabi Exchange, IFAD acronym, and launching the Murban contract. Your thoughts on it, Chris? What's the problem that it will solve? What's your outlook for it?
I think Andy raises an interesting point about assertion of relevance in terms of marketing the barrel, and I think that there's strength to that. I think the real crux of it is, are we going to see the availability, the liquidity around the barrel to create a fungible platform to establish a pricing benchmark there against the DME, and is there going to be a willingness to allow the barrel to trade freely? And that's not something that I've fully developed my view on, but I think that's critical to the whole equation. I think to Andy's other point about the US, there's clearly maybe not an increase in flow out of Iran. There is definitely an increase in flow out of Iran, but the hand that the U.S. is trying to deal with regulating the Chinese flow of Iranian oil and the engagement of the administration, obviously with Robert Malley's appointment back into as the Iranian go-between, one of the architects of GCPOA, there is a desire to re-engage, but a lot of debate it's even within the administration as to how that should get reestablished. Should they reinstate JCPOA and build off that, or should they try and reform JCPOA before they re-engage? And that's not clear at this point.
Chris, are the other European powers bystanders in this re-engagement? UK, Germany, France?
My understanding is that they've stood behind it, and they would definitely like to use it as the starting point without renegotiating an agreed contract already, while the US is a bystander on the contract that they've agreed to. So that I think with the ongoing enrichment program, that there is a desire on all sides to re-engage. But I think that the difficult part for the oil market is that if those barrels continue to trade through murkier channels, it is very destabilizing to the market, because no one really understands what's coming and where it's coming. And obviously it trades at a different price point than equivalent barrels from alternative sources, which creates massive dislocations. So
So in a way, it would be better for OPEC if both Libya and Iran were inside this very wide OPEC plus agreement.
Absolutely. From a pricing point of view and a stability point of view, yes, because then at least the market understands where the flow comes from and what the balances really are. And
increasingly, we're seeing Venezuela leak barrels as well into that space that could grow potentially. Let's go.
I think that's, just to that point, I think that's a little bit more challenged, just because the ability to bring those barrels back, in any material way is a lot more challenged.
Yeah. Technically, that is, but you could see a Russia-China move there, given what the outstanding debts and so on. But perhaps, as you say, a little bit outside the immediate. Let's go to the survey question and give everybody in the room a chance to cast their opinion this morning. What is the biggest weight blocking prices from moving on above $70 a barrel? We were clearly on a consistent direction, and we have stalled at least for 5 days anyway. What is the reason? You have to choose between these four, I'm afraid. There might be another four to choose, but they're not on the list. But between these four, what do you think are missing? Number one is the 8 million barrels of idle supply that is existing on the sidelines. Two, uncertain demand recovery. Global inventories are still of a scale that are weighing down on the market. An uncertain vaccine rollout. Which of these four do you think is the biggest? They're all relevant, but which is the biggest? And give us your thoughts on that before we move to everybody for closing thoughts. Carole, we are coming to the end of the Middle East week, nonetheless, and the markets are on this trend line. Do you think there's anything that is there from a demand outlook? I think one of the things we're struggling with is this inconsistent emergence out of the COVID crisis. You're in Germany, still struggling. Italy has just announced further lockdown measures, and meanwhile, Andy's packing his swimming togs and wants to go to the beach. We have an inconsistent outlook for getting out of COVID.
Actually, you highlighted that in the survey questions, and in my opinion, I picked, for example, the uncertain demand outlook, because both inventories and the vaccines rollout kind of are related to, they translate into an uncertain demand outlook. But here in Europe, in Germany, really, they just opened up a few weeks ago, and now they are saying they want to go back into a lockdown, so not after months, but after just a question of weeks, to highlight the scale of the problem that they are facing, particularly particularly with the virus mutation across the region. And really, when we think about the outlook for demand, again, things are improving, but the picture remains pretty scattered around the world. So we see that there is more, I mean, yes, it's increasing. We saw the IEA's publication, which was quoted almost everywhere, but we see, again, more cautious outlook, especially in terms of what that would translate in terms of prices. Actually, it was interesting to see that the IEA was not as aggressive as before with respect to the supply gap and referring to markets being comfortably supplied for the next few years. And they refer also to the inventories that you, Sean, highlighted earlier. So in my opinion, as long as we don't have really the virus under control in at least the major economies in the world, I think we will continue to have this kind of volatility. You know, one week we talk about prices sustaining gains, another week we talk about prices sustaining losses, and we should expect this kind of price volatility to maintain and to be maintained in the coming months because of the uncertain outlook with respect to the virus. Get that under control, and then we can put perhaps more certain figures on whether on demand, supply, and prices.
Andy, your closing thoughts as we're, still now days away from the next OPEC meeting. And if we are to maintain this trend of surprise, what is the next surprise that OPEC plus His Highness, the Prince of Saudi Arabia, could present to the market?
Well, it's when they're going to bring more oil back, right? And we heard.
Would the surprise be bringing it back, or would the surprise be not bringing it back?
Yeah, well, I mean that's a good question. I mean, Prince Abdulaziz was talking yesterday at a conference in Berlin, and interestingly, he was talking about the long-held Saudi goal of reducing oil burn from utilities and power generation in the kingdom. I think what's gone missing.
Up to 1 million barrels a day.
Up to 1 million barrels a day. Yeah, it's huge. So that goes beyond just power and cogeneration and desalination, etc. But I think that the market's forgotten about this. I really do. I think that we've been focusing so much on COVID and return of demand and so forth. Actually, we're coming into peak summer season in the Gulf, and that's when you get Saudi burning every barrel it can to keep its power generation at maximum capacity. That has an effect, a knock-on effect on markets. So, there are going to be adjustments that come from OPEC which are just seasonal. I think, look, here's an outside idea to answer your question, though. I think for oil markets, a key indicator here is the Olympics. If the Japanese go ahead with the Olympics in Tokyo and people can go and you can get on your plane and you can fly there, this is a huge event, drags lots of people in. It's one of the biggest economic events that's related to a sport. And we started actually the conversation with Chris talking about sport, the America's Cup. But if the Japanese go for the Olympics, what does that say? It says that we're much further down that road to economic normality globally than we were, we may have thought we could be. So I watch that very closely because, that's going to come in the summer. It's going to be a big indicator of where we are globally. And if people are getting on planes, going to Japan to watch people run the 100 meters, etc., that's demand. That's oil demand. And that's what consumers want to see. It's what producers want to see.
It's a long way to go to watch 100 meters. Who's even in the 100 meters these days? I don't even know. Is there a Usain Bolt next generation?
I don't know. He's gone. He's retired.
It's maybe they need some new stars. But nonetheless, let's get the answer to the survey and give Chris the last word. So the result that 51% uncertain demand recovery is still the overwhelming choice here this morning. Chris, your thoughts on that? And I'd also welcome Chris' commentary on the IEA midterm report that came out yesterday. I don't know if you got a chance to look at it, but one of the things that were in it was a forecast that OPEC and particularly the Gulf states are going to need to increase their production significantly in the coming 5 years to avoid a real supply crunch.
Well, I think just starting with that, I think that's probably true because we're expected at least by 23, 24 to get back up over 100 million barrels a day of demand, and alternative non-OPEC supply has been curtailed because of lack of investment. So from a cyclical point of view, I think that the incremental 8+, Abu Dhabi's obviously talking about producing more than their OPEC quota, or the ability to produce more than OPEC quota. And Saudi has the capacity to, but that oil will be called on in the medium term for sure. In terms of the survey, I always wish when I do your survey, Sean, that you give us an A and a B together, because I think it's betwixt and between. The lack of supply plus the perception on demand is there. I think again, Andy's point on that. When does the market feel like it's opening up? I think we have a very different perspective here in the UK, because actually the vaccination program has been working, and people have a date certain when they're told that things will return to normal. And I think that's given a huge amount of confidence to the market here. And I think Europe's in a very different place, because they are behind on the rollout, and the rollout has been compromised. My personal view is more politically than by medical science. It's been compromised politically, and therefore there's a lot more uncertainty. So you have that balance between incremental supply and when is it coming. Let's be clear, it's needed, assuming that the demand recovers as we expect it to recover through the second half of the year. So as I finish, as I started, I think we're at an inflection point, whether we're in the super cycle or not. It's not only the fundamentals of oil supply demand, but there's financial considerations there, there's inflationary considerations, and the commodities in general have done very well because the incremental demand is there. I'm thinking specifically about the metals. So we will see over the next 2 months how this plays out. But from this perspective, from our perspective, things look better going forward, a lot better than they did going into the first lockdown.
Would you expect another surprise from OPEC Plus, Chris? Would you think that now they're sort of come into line with the global consensus?
I think I'm not sure I'd characterize it as a surprise. I think OPEC is going to, and they've already made that very public, they're going to finally balance the market by their regular and often meetings. And it's really just a question of how many barrels they release when.
Okay, well, let's leave it there and wrap up the first year anniversary session, and thank our speakers, Andy Critchlow, Dr. Carole Nakhle, and Chris Bake of Vitol. Thank you so much. And I just want to conclude by giving a shout out to Andy's map, the crude map that he has built. It's really quite a spectacular tool and quite useful if you're looking to have a profile across the different crudes. Thank you very much, everybody. Have a great weekend, and we'll catch up with everybody come Sunday for the weekend review. All the best. Thank you so much.
Thank you.
Thank you. Thanks.